Hello A2 students. So today I will be teaching you a new topic, that is your cash flow statement. That's under chapter 37. So let us begin. So before we begin, you need to understand what is cash flow statement. So if we have to define cash flow statement, this is how you can define it. It's simply the inflows and outflows of cash from relevant activities. The relevant activities are either your operating activities, investing activities, or your financing activities of the firm. So the inflows and outflow of cash from operating, investing, and financing activities is your cash flow. Now, why do we need to study cash flow? That's the question. So there are two reasons why we need to make cash flow. Basically, cash flow is prepared to overcome the limitations of the financial statements. So when we talk about financial statement, let's talk about statement of financial position. So if you compare the statement of financial position between two consecutive periods, it simply shows the amount by which cash has increased or decreased, but it does not show the reason for its change. So to remove that drawback, cash flow statement is prepared, and cash flow shows the reasons for the changes. Similarly, the income statement of a business concern is always prepared on accrual basis, and it may show profits, but the cash received out of these profits may be low to run the business. So since the income statement is prepared on accrual basis, what happens is the income statement can show profits, but we may have a very low cash balance, to run the business. So the reason for this difference, the reason or the causes for each difference is shown by your cash flow statement. So these are the basic two reasons why we make cash flow statement. Now, uses of cash flow statement, if you want to talk in a broader sense, well, we can say the first use as to know the inflow and outflow of cash flow from relevant activities and its reason for change. The statement explains why profit and loss are different from changes in cash and cash equivalents. Provides information that helps to assess the liquidity, viability, and financial adaptability of the business. So you know the term liquidity. Liquidity is the ability of the business to pay short-term liabilities. And then cash flow statement, since it shows the inflows and outflows of cash, it gives an idea to us about studying the liquidity portion of the business. Efficiency. The statement provides information that enables users to assess the efficiency or inefficiency of how cash and cash equivalents have been used during the financial period. So during the financial period, we can study how the cash has been used in order to know the efficiency or inefficiency of the business. The statement shows sources of internal financing and the extent to which business has relied on external financing. That's it. Another one. It reveals information not disclosed in the income statement. This helps in financial planning. So here what it's trying to say is it reveals the information not disclosed in income statement, means in the income statement you will not see that the inflows and outflows of cash and its reasons. So this is shown in the cash flow statement. So it helps in comparison purpose. You can compare between year to year or between the firm. That's the important thing. And it helps in forecasting future cash flows. So through the use of cash flow statement, it helps you to forecast future cash flow as well. So according to our international standard, International Accounting Standard number 7, all limited companies are required to prepare the cash flow statement. So here is written All limited companies must prepare financial statements that adhere to the UK Companies Act 1985 as amended by the UK Companies Act 1989 and to international accounting standards. So the statements required to be produced as a part of financial statements. The statement provides guidelines for the format of cash flow statement. The statement is divided into 3 categories. So cash flow statement is a part of your financial company's financial statement. It is stated by the International Accounting Standard Board number 7. So in order to prepare your cash flow statement, it is divided into 3 categories. You have 1 to 3 here. The first one is your operating activities, the second one is your investing activities, and the third one is financing activities. So if we talk about operating activities, it refers to the main revenue generating activities of a business together with the payment of interest and tax. So you need to understand this main revenue generating activities. So that is the main focus in your operating activities. Investing activities is the acquisition and disposal of long-term assets and other investing activities. It means the buy and sell of long-term assets like your plant and equipment, furniture and fixtures, motor vehicles, and other investment activities like investment in shares of other companies, investment in debentures of other companies, etc. So these falls under investing activities. Then financing activities relates to the issue of shares. So issue of shares and redemption of shares, and then it also refers to changes in long-term borrowings, like if you have taken a long-term loan and if you have made repayment of long-term loan, these fall under financing activities. So basically 2 things that one should hear. It's related to shares and loans, long-term loans. So now if you look at this picture will help you remember the the 3 divisions or the 3 headings that are required to be remembered by the students in your cash flow statement. Here you can see the picture is ostriches are invading France. You can see it's been invading, the ostriches are invading France. So here ostrich refers to operating activities, the invading picture is your investing, and then you can see the flag of France, that's financing activities. So remember this picture to remember the 3 headings: operating, invading, and financing activities. Operating, investing, and financing. So let us understand some transactions that result in cash inflow and cash outflows. So towards the left hand side is a list of inflows. All the inflows we are supposed to add it, this plus sign. And towards the right hand side there is the outflow. You can see the outflow of water, that's your minus. So all the outflows need to be minus. So if you remember this generally, you don't need to memorize this, you just need to understand. So profit results in inflows, we need to add it. The reverse of profit is losses, so losses is only outflow. So just remember the reverse is your outflow. Interest received, reverse becomes interest paid. Interest income received, interest expenses paid. Dividend received, dividend paid. Tax refund. Tax refund means sometimes we make excess payment of tax to the government. So if the government, that is your tax office, refunds the tax, that's your tax refund. So that's your inflow. The tax payment is your outflow. Sale of non-current assets is your inflow. Purchase of non-current assets, outflow. Increase in share capital. Increase in share capital means issue of shares, so it's inflow. And then redemption of shares. Not all shares are redeemable, so if they are shares with the redeemable option, decrease in shares means redemption, so that's your outflow. Increase in debentures. Increase in debentures means we have taken loan, long-term loans, so it's inflow. The reverse of this is redemption of debentures. So if you are making payment of debentures, obviously cash goes out, so minus. Increase in long-term loans. So if you have taken long-term loans, that's your inflow. Repayment of long-term loans, outflow. Decrease in current assets except for cash and bank balance. So beside cash and bank balance, if there is decrease in current assets, it results in inflow, like decrease in trade receivables. So decrease in trade receivable, what you need to understand is initially whatever was the trade receivable, if it has reduced in the current year, it means there is a cash inflow to the extent by which it has reduced. So decrease in inventories also inflow. The reverse of this will be outflow. So if there's increase in current asset except cash and bank balance, it's your outflow. Example, increase in trade receivable, increase in inventories. Then increase in current liabilities will be your inflow. Example, increase in trade payables. The reverse of this is decrease in current liabilities. There's example, decrease in trade payables. That's your outflow, which you need to remember. So cash flow preparation methods. There are two methods of making your cash flow statement. One is the direct method and the other is indirect method. So the only difference between these two methods is in the calculation of cash flow from operation. So while making the cash flow statement, we need to make the cash flow from operation, cash flow from investing activities, and cash flow from financing activities. So the only difference in these two methods is in calculation of cash flow from operation, and we will learn only the indirect method here as it is prescribed by International Accounting Standard 7. So we will not study direct method, we will be only focused on indirect method as required by the International Accounting Standard number 7. So let's proceed forward. So first thing, we are going to learn how to prepare cash flow from operating activities under the first heading. So you can see ostrich here, ostriches means operating activities. So in the left side we have all the inflows, the right side is your outflow minus. You can see up a heading. So before I explain to you what are the inflows and outflows in your cash flow from operating activities, let us see the format that eventually we'll be making. So this is an example of the format that we'll be making. So to calculate cash flow from operating activities, you have to start from profit from operation. The profit from operation, I hope you understand this profit from operation term. So to understand profit from operation, let's have a look at the income statement. See, this is the income statement which we studied in our IAS level. So in your income statement, revenue less cost of sales gives you a gross profit, and then in the gross profit, when we deduct expenses, it gives us profit from operation. There we deduct finance cost. The finance cost are your debenture interest and the preference dividend. That's deducted. You get profit before tax. There you deduct tax. You get profit for the year attributable to equity shareholders. That's how it works out. Now, while making your cash flow from operation, you need to start off from profit from operation. This 1079, this point. So make sure you understand that we are doing from this point. So now, if you look at the format here, profit from operation. We start from the point, that's profit before interest and taxes. So assuming is 50,000, the adjustment for, we write the heading adjustment for, and then you add depreciation for the year. Increase in inventories, subtract. Decrease in trade receivable, add. Positive means add. Increase in trade payable, add. The net figure, you solve this 50 plus 12 minus 3 plus 2 plus 4, you get 65,000. That's called cash from operation. Cash from operation. There you deduct interest paid and tax paid, you get cash flow from operating activities. That's how we work out. Now here depreciation charge has been added while increase in inventory has been subtracted. Now we'll study the reason why this is plus or minus. Why some are minus and why some are plus. So for that we will say this format. So in order to remember your cash inflow, you need to understand these three headings. The first one is non-cash expenses. So when we talk about non-cash expenses, depreciation is a non-cash expenses, because when we show depreciation as an expenses, there is no outflow of cash. You can look at the income statement. You see, under less expenses, we are deducting depreciation 56. This is your non-cash expenses. Cash doesn't go out. So basically what we do out here is, since we are starting from profit from operation, we are trying to basically come to a cash balance starting from this point. So at this point, since we have deducted depreciation, which is non-cash expenses, we are adding it back. We're adding it back to get the true value of cash. So depreciation will result in inflow. That's why when we look at the format here, see depreciation is added. That's the reason why it's added. Amortization of intangible and fictitious assets. So for intangible assets like goodwill, patent, trademark, copyright, we use the term amortization. It is same as depreciation. Depreciation is the term used for non-current assets, while amortization is the term used for intangible and fictitious assets. So if there is depreciation, amortization, these are non-cash expenses, we need to add it up to get cash flow from operation. The second point is your non-operating expenses and losses. Now, what are your operating expenses for the business? First, you need to understand that operating expenses are the expenses incurred to run the business, or is the expenses incurred in your normal trading activities. For example, if you look up here, the wages paid, other general expenses are your operating expenses. So you could have like rent paid, electricity paid, staff salary paid, office and administrative expenses, etc. So these are all expenses that are operating expenses. Now when we say non-operating expenses, these are not normal expenses, or these are not the normal expenses of the business. So if you look here, loss on sale of non-current assets. Now sale of non-current asset is not a normal trading activity. It is not done frequently. So this is your non-operating loss. So where there's a loss on sale of non-current assets like sale of plant and machinery, vehicles, furniture and equipment, if there's a loss, that comes under the heading of non-operating losses. So non-operating losses we are going to add back to show inflow. The reason is expenses. The reason why we are adding non-operating expenses is because we are calculating only cash from operating activities. So since this is not a part of operating activities, we are adding it back to get the true picture of cash flow from operating activities. This changes in working capital. So changes in working capital, you need to understand two things. That's your current asset and current liabilities. Working capital is current asset minus current liabilities, remember that. So if there is decrease in current assets except your cash and cash equivalents, we need to add it to show it as an inflow. So decrease in trade receivable, decrease in inventory, we are going to add it. It's very simple. The decrease in trade receivable portion is the portion of cash receipt, same way for inventory. And in the case of current liabilities, this is reverse. Think reverse. Increase in current liabilities, you need to show it as inflow. So increase in trade payables is your inflow. Now once we understand this three headings for inflow, the outflow will just be the reverse. So non-cash expenses would be non-cash income. So non-cash income, example, appreciation of non-current assets. So appreciation of non-current assets is your non-cash income that is added in your income statement. So we need to subtract it, to get cash flow from operating activities. Non-operating income and gain. So non-operating income and gain, we are subtracting it because it is added in the income statement to get cash flow from operation. Now we are subtracting it because here we are required to calculate only cash flow from operating activities. So gain on sale of non-current assets is the reverse of your loss on sale of non-current assets. Discount on redemption of debentures, the reverse of premium redemption of debentures. Dividend interest received. So dividend interest received, we will subtract it if we assume that it is not part of operating activities. So here there's two asterisk out here. This asterisk is to indicate that in case of dividend and interest received or paid, we can treat it either as investing or operating, whichever we choose to. This is allowed by the International Accounting Standard 07. So it allows us to treat it as either operating activity or as investing activity, but whatever method we use it, we have to follow it consistently. Means you shouldn't change it frequently. So changes in working capital, it will just be the reverse of this. Here with the decrease in current assets, so here is going to be increase in current asset, that's less. Here increase in current liabilities, so here is going to be decrease in current liabilities, that's going to come under here less. So that's how we learn cash flow from operating activities. Now there is one more thing under outflow you need to put here, that is your interest paid and tax paid. So when there's interest and tax being paid, there is outflow of cash, so this should go out here. So when you are making cash flow from operation, now we need to focus on these headings. So now let's have a look at the full-fledged format. So this is how we will be making profit from operation. We started from profit from operation assuming 50,000. Depreciation, we are adding it back because it's non-cash expenses, we are adding it back. Increase in inventories, that's your increase in working capital. The decrease in working capital was add, so increase in working capital is less, 3,000 you have. Decrease in trade receivable, decrease in current asset add, so 2,000. Increase in trade payables, increase in current liabilities also add, so add 4,000. So when you add this up, solve this part, you get 65,000 as cash flow from operations. Then we deduct interest paid and tax paid during the year, you get the cash from operating activities. That's how you prepare cash flow from operating activities. So let's go to the next one now. So now next heading is cash flow from investing activities. Invading. So this is very simple compared to your operating activities because it has very less things to remember. So here you need to remember inflow as proceed from sale of non-current assets. So when you sell non-current assets like plant and machinery, vehicles, furniture, etc., they will be inflow. So this here now includes both tangible and intangible non-current assets. So when we talk about tangible assets, means which you can touch and see as it has physical presence. Example of tangible non-current assets is your plant and machinery, furniture, fixtures, etc. So if there's a sale, there's inflow here. If there's purchase, it will be outflow here. So purchase of non-current assets. So if you talk about intangible assets, it means those assets which you cannot touch and see as it has no physical presence. Example of intangible non-current assets are GPTC, goodwill, patent, trademark, copyright. So if you have purchased them, that's your outflow minus. So very simple, proceed from sale of non-current assets, both tangible and intangible, that's your inflow. Outflow, purchase, the sale, this is purchase. Purchased of non-current assets, both tangible and intangible, that's your outflow, together with long-term non-current assets. So together with other long-term non-current assets could be like your investment. So if there is sale of investment plus and then purchase of investment minus. And then for inflows, if you have received interest on your investment and if you have received dividend on your investment, that's also your inflow out here. Now this is optional as we studied here. The star shows optional. You can either treat it as investing or operating. You have option to treat this interest received and dividend received. Okay, so India Council allows to treat it as operating or investing, whichever you choose it, but it should be consistent over the years. So let us have a look at the format. It's very simple format. So purchase of non-current assets goes outflow minus. Proceed from sale of non-current assets, inflow, so positive. Interest received positive, dividend received positive. You solve this, you get net cash from investing activities. Here's a 16,500 is bracket, you can say used, and if it's positive you can say inflow from investing activities. So now cash flow from financing activities, this is also very simple. So when we talk about inflow, you can remember issue of share capital. So this issue of share capital, that's your inflow. Just the reverse of this is redemption of share capital, or you can say repayment of share capital. So when you repay, we give money, so that's the outflow. Raising or increasing loans, so if you take loans, long-term loans, or issue debentures, that's your, there will be inflow of cash. The reverse of this is your repayment of loan and finance leases, lease liabilities. So this results in outflow. Now the other thing that results in outflow in your financing activities is dividend paid. So if you have paid dividend, this is also outflow. Dividend paid, so dividend is paid to share, you can say shareholders, so that's your outflow, minus. And when you look at the format, this is going to be the format. Cash flow from financing activities, so proceed from issue of share capital is positive. This will include both the share and the share premium amount. So if you have issued shares on premium, the premium part should also be added here. Repayment of long-term borrowing, so if you are making payment of long-term loans and debentures, that's your minus out here, cash outflow. Dividend paid, outflow. So the net result is your net cash from financing activities. That's how we do. So moving forward, now let us have a look at the cash flow statement in a combined form with all the three components. So this is how it's going to be. This is your cash flow from operating activities. So you start from profit from operation, and then the result is net cash from operating activities 50,000 positive. Then we have cash flow from investing activities solved. Then there's net cash used is 16,500 negative. Then from financing activities, cash flow from financing activities, you have your net cash from financing activities 46,000. Now after making under these three headings, we add them up. You have to add 50,000 minus 16,500 plus 46,000. So when you add up, you get the total, and that's called net increase in cash and cash equivalents. So if it's positive, we say net increase. If this had turn out to be negative, you would use the word net decrease in cash and cash equivalent. Now here we need to add opening cash and cash equivalent. So opening cash and cash equivalent, you add this 10,000. Now this is obtained from your quotient, so it will be something like this. Suppose this is an extract of statement of financial position 2019-2020. Cash and cash equivalent, you have to add 10,000 in 2019 and 91,500 in 2020. So here cash and cash equivalent at the beginning means you need to put this 10,000 here. Now we will add these two up. 81,500 plus 10,000 will give you 91,500, which we refer to cash and cash equivalent at the end of the year. So make sure you understand this format. In the end, we are supposed to use these three terms. 81,500 is obtained by adding the three headings. Cash and cash equivalent at the beginning is obtained from the quotient, this 10,000, and when you add these two up, you get 91,500. That's cash and cash equivalent at the end of the year. And this amount, whatever amount you get at the end result, the closing result, should be equal to the cash and cash equivalents at the end of the year given in question. If these two are correct, it means your answer is correct, else you have made mistake somewhere. That's how we understand it. So now this cash and cash equivalent is being used here. What is this cash and cash equivalent? So you need to understand this. So at the end of the statement, the net increase in cash and cash equivalent is shown. So see here at the end we have shown it, these three at the ends, both at the start and end of the period under review. So we have at the start cash and cash equivalent 10,000, and at the end 91,500. That's what it's saying there. For this purpose, cash is defined as cash on hand and demand deposits. So in your cash flow statement, the word cash refers to cash in hand and demand deposits. So if you have deposits which you can convert to cash on demand, that's your cash. Cash equivalents. So cash equivalents are short-term, highly liquid investment that can be easily converted into cash. This is usually taken to mean money held in term deposit account that can be withdrawn within 3 months from the date of deposit. So anything that can be converted to cash easily, or you can say highly liquid investment that can be easily converted to cash is your cash equivalence. So normally here is saying that the term deposit is taken as cash equivalent because it can be converted into cash within 3 months. Then there's the bank overdraft. Now bank overdraft is our current liability which we studied while making our fund accounts or your financial statements. But here, to prepare your cash flow statement, you need to understand that bank overdraft should be treated as cash equivalent and not as current liabilities. If you start treating it as current liabilities, you will end up putting this data in cash flow from operation. That's not what we are supposed to do. So remember, bank overdraft should be put under the heading cash and cash equivalents. Now, the allowable variations as per International Accounting Standard, which I've said it, but I'm going to repeat it one more time. So IAS 7 allows some flexibility in which the cash flow statements can be presented. Cash flow from interest and dividend received and paid can be shown as operating or investing or financing activities. Whichever is chosen must be applied consistently. So regarding interest and dividend paid or received, you can treat it either as operating or as investing or financing, but whatever methods you do it, you must follow it consistently, means follow the same method over the years. Cash flow arising from taxes on incomes are always classified in operating activities unless they can be specifically identified with financing or investing activities. So the tax paid up here, you see a tax paid and interest paid, you can put in operating activities under normal situation unless and until question mentions that it is an investing activity or financing activities. So thank you. This is the basics for making your cash flow statement. I will be doing an example from your book in the next video. So hoping to see you all there. Thank you everyone.